Hello, Jason Bates here, owner of Electrum Financial, located right here in beautiful Scottsdale, Arizona, where a mortgage is not a flip of the coin. If you like the lowest rates at the lowest cost, then allow me to put my 30 years of experience to work for you. You've got nothing to lose. Here is this week's mortgage market at a glance. Markets were squarely focused on last Friday's much anticipated Jackson Hole speech from Fed Chair Powell. The Fed has 8 scheduled policy meetings per year. At the conclusion of those meetings, the Fed releases an official statement which includes any potential changes in the Fed funds rate. The Fed funds rate is quite different from mortgage rates, but the things that lead to the Fed to adjust its rate hike pace often have an impact on longer-term rates like mortgages and 10-year Treasury yields. All that to say, there was no official policy statement from the Fed this week, and no change to the Fed funds rate. Jackson Hole has been responsible for helping to telegraph a few important shifts in Fed policy over the years. This year was perhaps more deserving of some anxiety considering the Fed's policy path as communicated by Powell in late July and multiple Fed members in the subsequent weeks. In short, the Fed funds rate has risen quickly enough that policymakers can begin to consider slowing the pace of rate hikes. Maybe. The promise of that policy shift coincided with several downbeat economic reports in late July. The result was July standing as one of the best months for downward movement in mortgage rates in decades. The market has been pushing back against that exuberance ever since, including the St. Louis Fed Chair James Bullard, who has said that the Fed funds rate needs to be at 4% by the end of the year and be held there to fight inflation. That tells me that inflation is far from being under control. The current Fed funds rate is at 2.5%, and with only a few meetings left, the Fed might be signaling a more hawkish approach to raising the Fed funds rate. Now, to reiterate, the Fed's late July message was highly conditional. That condition is inflation. The slightly friendlier inflation data would need to continue to show signs of slowing for months to build a disinflationary case. Inflation is a key reason rates have been as high as they are, and a handful of weak economic reports didn't mean anything conclusive unless they were also joined by subsequent months of deterioration. Weaker economic data tends to coincide with lower rates. Now, to make matters worse, economic data began to improve in August and in some cases substantially. Then speculation increased that July's inflation news was more of a one-off due to a big correction in fuel prices. One of the reasons fuel prices dropped was because demand also dropped. Thus, it came to be that the market was positioned at the highest rates in more than a month before Friday's speech from Powell. With Powell bluntly reiterating everything we already knew, there wasn't much for the bond market to do. While that was good in the terms of avoiding additional rate spikes, it also meant that there was no compelling case for rates to drop quickly, especially when the fiscal spending is still out of control. The following chart shows the range-bound indecision in the 10-year Treasury yields after having risen throughout the week in advance of Powell's speech. Now, while the 10-year yield doesn't directly dictate mortgage rates, the two are in lockstep most of the time. Now, there is a bit of a counter-argument to the notion that the market was fully prepared for Fed Chair Powell's direct tone. It comes courtesy of the reaction in stocks. Remember that friendlier Fed policies are like proverbial rising tides that lift all boats. They help both stocks and bonds. And conversely, when the Fed shifts toward a tighter policy, stocks and bonds often lose ground together. That's basically 2022 in a nutshell. A big unfriendly shift from the Fed, followed by heavy selling on both sides of the market. Sprinkle in a few unpopular spending policies and the markets will take notice. With that in mind, Friday's stock market reaction to Powell suggests stocks were not nearly as well positioned as bonds. In fact, stocks lost so much ground that bonds may have had a bit of an additional benefit from investors fleeing the stock market to seek safer havens. In other words, rates may have risen more noticeably after Powell's speech were it not for the stock market taking the news so hard. At the end of the day, the rate market is probably right about where it should be. Not at the absolute highs of 2022, but not taking too much of a lead off back down toward lower rates. In order for a substantial drop to make sense, we need several more friendly inflation readings. At least one sector of the economy can already claim to be experiencing quite a bit of drama thanks to the shift in rates. If you're anywhere close to the housing market, you already know. This week brought more of the same in that regard with a big drop in new home sales. Pending home sales also declined, but at a far slower pace in this week's data, which covered the month of July. The previous chart doesn't look great, but keep in mind that July only accounted for 1% decline versus June, whereas June dropped almost 9% versus May. This deceleration prompted a hopeful comment from NAR's chief economist, Lawrence Yun, who said, and I quote, "In terms of the current housing cycle, we may be at or close to the bottom in contract signings," end quote. Let's hope he's right about that. This week could be critically important in shaping the rate trend because it brings several economic reports that have recently had a big impact on rate momentum. Chief among these is Friday's jobs report, which is expected to show a major deceleration in job growth from July's 528,000 to 285,000 in August. We'll also get June's FHFA home price index. While that's not a big market mover, it's part of a larger data set that helps determine conforming loan limits. June marks the end of quarter two and will round out 3 of the 4 quarters that feed the conforming loan limit equation. The equation becomes complete in late November when quarter 3 home prices are released. And so there you have this week's mortgage market at a glance. If you'd like to know more, reach out to me. I'd like to meet you. Thanks for watching, and if you're looking to purchase or refinance a home in Arizona, I'd like to be your broker of choice. Until next time, take care and stay safe.